So unless you really have a much, broader perspective of life and not think life in terms of daily outcomes or quarterly outcomes or even an annual outcome, and just focus on the happiness, I feel it keeps your brain and mind, free. It doesn't get blocked or, sort of pressured by the expectation of the outside world.
Hello and welcome everyone. I am Vishal Khandelwal and this is the 1% Show. This show is an open-ended exploration into the minds of the wisest people around to help us learn to think, invest and live each day a little, even as little as 1% better. You can learn more at vishalkhandelwal.com. My guest today is Samit Vartak, founding partner and chief investment officer of SageOne Investment Managers. Samit is a CFA charter holder, an MBA from Allen School of Business of the Washington University in St. Louis, and holds a Bachelor of Engineering degree with honors from Sardar Patel College of Engineering, Mumbai University. I have known Samit for the past 5 years and have had tremendous respect for not just his money management skills, but for the kind of person he is. It's like if I were a money manager, I would have wanted to be like him, hardworking, talented, and successful, yet quiet and composed at all times, and also as physically fit as he is despite the stresses of his work. With this and no further delay, Samit, welcome to the 1% Show, and thank you so much for agreeing to do this.
Hi, Vishal. It's my absolute pleasure to be here, and thank you so much for the kind words. If you remember, 5 years ago, you were the first one to interview me, and at that time, I didn't know too many people around because I wasn't really part of the investor community, and somehow I think you heard about me and you interviewed me. And probably that's the start of sort of my public, investing life. And really, thank you so much for being there for the retail investors. I think the kind of value that you have added in framing the investing life for a lot of retail investors who need guidance, it's phenomenal, and really appreciate you doing that for the entire investment community.
Thank you so much, Samit. I think we are partners on this journey together, right? So thank you for being there. And let me also take this opportunity to congratulate Neeraj Marathi, my friend, who connected me with you, right? And who's helped me connect with so many wise people, wise investors over these years. So
yes.
I must thank Neeraj as well. Here.
He's a very good friend. Yes, thank you.
I'm sure. So Samit, my first question to you is about success and happiness, especially because you wrote about these subjects sometime in June this year. You mentioned how despite SageOne's assets under management crossing 2,100 crore in 2021, from less than 2 crore when you formally started advising people in 2012, it has not changed the level of inner happiness that you have felt all these years. So I would like you to elaborate more on the topics of success and happiness. How do you measure them and what these mean to you in your life as an investor and money manager?
Sure. Yeah, Vishal, I think this is one of the most important topic that I keep on thinking about, because I came from a very, small village, and my father was a farmer, and he's a farmer even right now. And as a kid, we used to play around. I mean, it was, you go to school early in the morning and then come back by 1 or 2 o'clock. And the rest of the time you just played, you go to the beach, you climb trees, you collect fruits, all kinds of things. And we all played together. Even we have a lot of workers in the farm who are Adivasis, and their kids also played with us. So we had a really happy life. Even though my father struggled, because farming doesn't really make money. There is always you always live on taking loans because there is so much investment that you need to do, and you get the fruits at the end of the harvest season. And most of the time, harvest doesn't come right, and you're always under loan. But that never really affected the happiness or the enjoyment that we had in life. And even when I go back home, I see the same Adivasis, and they are enjoying their life. They don't have any stress. I mean, If you ask them what are your achievements, they don't probably have any thing to talk about. It's just that they are happy, they are enjoying their life. And unfortunately, what's happened is that we always keep on measuring our success based on the Western parameters. I think that's one of the most unfortunate thing that has happened to India. And you run after things because the measurement parameters are so different. You keep on running after things without really realizing that it doesn't really change your happiness in terms of how you live. I mean, as a fund manager, yes, from an outside world, you would think that I have achieved so much, and so from an outside world, from a Western perspective, you can probably think that I'm a successful person, but the success is meaningless if you do not feel that inner happiness. And that inner happiness doesn't come uh, just with achieving outside material things. You have to look inward, and from that perspective, I think one of the most profound stories that has struck to me, and probably many of the listeners probably have heard, it's about the Chinese farmer story, where there is a Chinese farmer. For those who haven't heard, I'll just repeat the story. So there is a Chinese farmer, and one day he has a horse and he runs away. The horse runs away. So at the end of the day, when everyone gets together, the neighbors come in and they ask and they say, it's sad. It's too bad that you had only one horse and it's run away. And he says, yeah, maybe. So next day the horse comes back with 7 wild horses. And then the neighbors again come in the evening and they say, oh man, you're so lucky, it's so wonderful. And he says, maybe. And then the next day his son wants to try out one of the riding one of the wild horses. And while he's trying that, he falls and he breaks his leg. And then again, the neighbors get together in the evening and they say it's too bad. Sorry. He said, yeah, maybe. And then the next day, there is a recruitment. The recruitment officer for military, they come in and they want to take, because there is a big war going on. So they want to recruit all the youngsters. But since the son's leg is broken, they reject him. And then again, the neighbors come in and they say, oh, it's so wonderful, you're so lucky. And he says, maybe. So this is how life is. I mean, life is, you do not need to judge each and every event because you do not know what that event means for your entire life. Something which may really look bad turns out to be the most wonderful thing for that happened for you maybe 2 years down the line or 10 years down the line. So for me, I've stopped judging events. I feel there are millions of options that you have in life, and out of which you do not know what is the best for you. You have a very limited knowledge, because you only have those 5 senses through which you look at the world, whereas there are million probabilities for your path in life. So why do you want certain thing? Because you do not know exactly what you want and what would make you really happy. So from that point in time, I have made I do not judge any event. I am fine with whatever happens. It's accept whatever happens in your life. Let the universe unfold in front of you and accept it. Why do you want to create friction by wanting certain things? Let the universe deliver it to you and you'll be okay with, whether it's a good or bad, because it seems at that point in time, and you don't have to stamp it with, black or white or a good or bad. And that's how I live life. And, it's easier said than done, because after all, there are so many influences that you have in life, and especially when you are in the fund management industry, you're always compared. So there is always comparison, and you have to keep on delivering. There are investors, there are pressures. So unless you really have a much broader perspective of life and not think life in terms of daily outcomes or quarterly outcomes or even an annual outcome, and just focus on the happiness, I feel it keeps your brain and mind free. It doesn't get blocked or sort of pressured by the expectation of the outside world, and you work also very efficiently. And so it may seem more spiritual in nature, but I think a lot of it is really practical. A lot of I think Indian spirituality, especially if you look at what the Upanishads tell you, if you hear the commentary, as you learn more and more about it, you realize it's the most practical and most scientific way of living life, and there is really no way to differentiate between your material practical life and then the spiritual life. It's all integrated, it's put together. Sometimes as a kid, I used to think that spiritual is something which is on the side. It's good to have. Whereas as you experience life more and more, it becomes, it is the most integral part of your life. That is the main thing you are moving toward. And maybe as we go along, we will talk more about it. But that hopefully gives you a perspective of what success is. There's AUM and assets and all that. These are just numbers. I never really aspired for any of that. I'm okay with whether it was from 2 crore it had reached 50 crores, or from 2 crore it reached 2500 crores now. It's just part of your life.
You mentioned about spirituality, right? So of course there must have been great amount of learnings as you were growing at home, right? In the village, in your family, but what kind of reading have you done on spirituality? What does it really mean to you? And if you can just give us a real life example of how your lessons from spirituality have helped you in your experience as an investor and money manager.
So, I have been spiritual right from the start. It's just that the way what spirituality meant then and now, are very different. So, I remember, in villages mostly, they do believe a lot in, doing puja and a lot of, rituals. So I was part of that. I even started, doing puja myself, when I was like in 8th standard. But then, as you go along, you try to read more and more what it really means. And, at that point, I realized that a lot of, even my parents, there was a lot of fear of God that, if you don't do fasting, if you don't do this, it's not, God will not be happy. So, it just didn't make sense to me. If there really is, something called God, and if he's greater and much more wiser than your parents. Your parents don't judge you, and they're okay with whatever typically you do. If you do bad, they don't retaliate. So why should God do something like it didn't make sense to me. And then slowly I went to US, and then there they talk about the secret, the power of positive thinking, or of subconscious mind, and all of that. Again, slowly, it's a struggle to do that, because a mind can't remain positive all the time. And again, it didn't really fit what spirituality meant for me. And when I came back to India, I was fortunate to get close with a few friends who were on the spiritual path, and through that, I had read Gita multiple times, and it made sense to me. But it still wasn't clear what it meant. But I think what has really helped me is hearing a lot of talks on Advaita Vedanta. That is something which has really struck with me. And even Professor Bakshi spoke about Swami Sarvapriyananda. And I have been following him. I've been hearing his talks. When I went to New York, I also met him. sat with him, had some questions, spoke with him, clarified, because I had a tough phase, from 2018, 19, those couple of years. And that made me look even, deeper inside, like after having whatever I had achieved, great performance and great assets, why am I getting more and more sort of impatient? And why are these activities, because I had a break in the partnership, and a year, 2 years of performance wasn't as I had expected. So a lot of those things started affecting me, and that made me look deeper and deeper inside. So there are, I think, in Advaita Vedanta, it's a spiritual journey which has mainly, you can define it into three steps. One is Shravana, then Manana, and then Nididhyasana. So Shravana meaning you accumulate the knowledge. You hear from your teacher, you read, and you at least understand the theory of what spirituality means. In Advaita Vedanta, basically it's all about who you really are. Who are you? And it's, just to give you basic thought, it's in Advaita Vedanta, it's you are Brahman or you are Atman, right? But it's still a knowledge. Then the second step is Manana, which is basically you question everything about it. Whatever you have learned, you question, you talk to people, you argue about it, whether it really makes sense or not. And that's what, you need to spend much more time in contemplating what it really means to you than what you did in accumulating that knowledge. And then once you are sure, okay, it makes sense now, you have looked at the positive, negatives, you have played a devil's advocate role, you have spoken to multiple people, you have looked at the contra view, then you move to the third stage, which is Nididhyasana. Nididhyasana means that you apply that in your life, you try it out, and you live that life. And that's where in the spirituality aspect, it's the only way you can do it is through meditation, and in there also meditation, I look at it in two ways. One is the awareness meditation, which is more of the Vedantic meditation. And the second meditation is more focusing on, whether you're focusing on the breath. So it helps you calm your mind. So basically the role of meditation is how do you stop that mind chatter? Because the mind keeps on focusing on the outside objects. It gets distracted. And until you really calm those, stimulus of your mind, you do not really understand who you really are, and you need to experience that. It's a very long journey. Even I am nowhere close to anything that I'm still at that second phase of Manana. I do try meditation, but that helps. So when you equate that to sort of investing, investing is again, I feel, as an investor, you need to know exactly what is. So you need to learn about investment. So you can read books, you can take courses, you can do CFA, all sort of things to accumulate the knowledge. And then is the second step, which is the most important thing, which is the Manana aspect, which is you try to figure out what really fits you, because investments can be done through various ways, and it has to basically appeal to you. It has to fit your competence. It has to fit your temperament. And that's how you evaluate all the other, all options. Spend a lot of time on thinking, because I think what's happening today is people do spend a lot of time in reading. We get overloaded with data. There is so much data available on WhatsApp and emails and multiple books, but many spend inefficient amount of time or inadequate amount of time on thinking about what it really means. And you got to question why, how many stocks do I need to have in the portfolio? Why those, if I decide on 15, 16, why what kind of stocks, what kind of investment. If I read about Warren Buffett in the US, there is certain style that work. Does that apply right now? Does that apply and fit in India? Why Warren Buffett style and why not Joel Greenblatt style? So you need to question and spend a lot of time on that. And then the third step is basically living it. Then you experience, you do your own investment, you experience it, and it's a journey. That investment style that you develop becomes inherent part of you. So I think that definitely, the steps, the process are the same. And again, the meditation part. So meditation, I used to think that meditation is more of like a yoga exercise. Let me calm my mind for a half an hour or 1 hour, and then it's done. Like an exercise. I forget about it throughout the day. But that's not like, once I started learning about, Advaita Vedanta and more, Upanishad knowledge, meditation is actually your entire life, especially the awareness meditation, is that even when you are investing, you are doing an interview, or you are facing a really stressful time, you are really angry at someone, you are having a fight, if you are aware, just that being aware of yourself, just observing how your body reacts to things, calms everything down. So meditation has to become part of your entire life, whether it's an investing journey, you're living your practical life. It helps reduce many stresses in life. Otherwise you because of outside pressure, you end up living life that you think someone else thinks this is a successful life. You want to live the life that everyone else would perceive to be the most successful life. Whereas, the more you focus internally, you realize that you have to look inward, define a life for yourself. I mean, I want to really, tell you the story of, my investing journey, which also fits into this. Is that, see, I came from a village, so until 10th standard, I really didn't have. So after 10, we didn't really have, any colleges out there. So I came to Mumbai, and there I joined, Parle College, and everyone spoke English, and I really wasn't comfortable. I was very shy. I found it really difficult, to adjust to that life. And until that point, I had no idea what I wanted to do. I had no idea absolutely what are the even different options available. And I remember that after completing my 11th, I heard someone talking about IIT. There is a, IIT, that's the best engineering school. And by that time, it was too late. So anyways, I completed my 12th standard, got decent, 90 plus marks in the PCM, and got into, engineering. But I had no idea what I'm doing. So I completed my engineering. After that, I joined Mahindra and Mahindra. And again, it really didn't make sense. I didn't enjoy what I was doing. And one fine day, I was still living in our community hostel. And then one of my engineering friends, came in, and he said, "I'm applying for US. And I'm applying for some MBA schools." And at that time, it was a very physical process that you had to send a letter application. It would take 3-4 weeks to just get that application form out there. And then so he had spent many months doing that, and he had like a couple of extra forms which he didn't want to apply to. And he said, "Why don't you also think about it?" I said, "Okay, which are those colleges?" And out of them, one was Washington University, the Olin School of Business, which was like 16th rank. I said, "Okay," but I hadn't even given a GMAT or anything. So I prepared for GMAT, got decent score, applied for the school, just that school, at 1 or 2. And fortunately, they gave me a scholarship to do an MBA, and I, was able to go to the US. Even then, I had no idea what I wanted to do. And then when I, joined Olin School of Business, at that time it was that dotcom era, 97, 99 era, which sort of got me interested in investing, because a lot of my friends, these were all experienced, they had worked in the industry for 4 or 5 years, and then they had come to do the MBA. So they had money, and they were doing like day trading kind of a thing, because the IPOs were, doubling a day. And that got me curious. So I took a lot of these finance, courses. And then once I completed my MBA, I got a signing bonus. And that's where I invested that, into 1999. Unfortunately, that was sort of the peak of, the bubble. And I lost all the money. So that was the trigger for me to really get interested in something, because given my, father's sort of background, kind of debt level that he had, even to come to the US, we had to take sort of a scholarship from Tata Trust, 30,000 rupees to, get the ticket to fly. That was the first time ever in our sort of family life that someone had sat in a aeroplane. So with that kind of a background, losing that money, I mean, it had like profound impact on me. And I actually stopped investing at that point in time. And then slowly I started reading, thinking, enrolled myself for CFA. I spent just a couple of years reading things and understanding, because whatever I learned in MBA was like really basic knowledge. And that's where my, because of sort of that one event, until that point, a lot of things happened just randomly. This is what probably the universe, had designed for me, and it happened. I had planned nothing. And I was fortunate to find something which really I turned out to be good at, as well as something that really interested me. But then I didn't get into investment field until 2007. By that time I was already in my 30s, mid 30s. Right. So just to, a lot of people do say that you need to get into investments early in life, but sometimes your background doesn't give you that opportunity or option, right? But you should be okay with it. And I then became so passionate about equity. I went through. I was with PwC and then with Deloitte, and then the last job that I had before I really got into investment in 2007 was I was an associate director with Ernst & Young in valuation practice. But I was so passionate about investment that I took a pay cut of 70% when I joined. So I joined right at the bottom, like an analyst. But I was completely fine, from an associate director in valuation in Ernst & Young to sort of an analyst. And then again, I spent those 5-6 years, until I got that confidence. I went on ground, met companies. I didn't care, what my salaries was. I didn't even have much of savings. And then in 2012, I thought I have enough confidence. I need to start on my own. And I started, SageOne with, as I said, couple of friends, families. I said, I will not even take fees if I don't deliver for you. So for 2-3 years, I did not take any fees from those starting investors. I said, whatever I do for myself, I will do for you. So until 2012, whatever money I had was just the capital I had multiplied in terms of investment on my own. And so even when I started 2012, I was almost 40, right? With not much of savings, and still I took the jump because I knew that this is what I really wanted to do. I just followed my heart. And I think, that's and then since it didn't really matter to me, I kept on doing it, and then money just follows if you try to do it. It doesn't matter whether you achieve the money at the age of 25 or 35. You just follow the path, because life is all about experiences, and you just follow your heart. You do the thing that you really enjoy, because if you try to do something else, it may give you money, but in the end, your daily life will not be as enjoyable and happy. And I feel the measurement of success has to be based on happiness. For me, again, as I said, from 2 crore, whether it had been 10 crores, or I would have kept on doing the same thing. It's fortunate that, the performance delivered. And it only happened because I was fully into it. I never looked at my own money. I said, I have to deliver for the clients, because after all, when you take clients, it's your own responsibility. From your heart, you need to feel that I need to deliver returns for the investor, and that always has been the focus. So, spirituality talks about the same thing: is that you do whatever is best you can do, leave the outcome to the universe. The universe knows what is best for you. It will deliver what you really want. Don't try to stop that flow that is coming along. And in every decision that I take, I have two main factors that I think about. One is, every situation I need, it has to be thought with a lot of compassion as well as with intellect. So, you can't just follow your heart. Like, if I see if I meet a beggar, on the signal, with compassion, I might think that I need to help. But when I use my intellect, it may tell me something, something else. So, every situation, you take a decision based on full compassion for people around you, and use your full intellect, and then let the result come along. Whatever result comes, you just accept it. And that's how I live my life. How I live my investing life. And I think it's spirituality and living life. There's not much of a difference.
That's great. I think wonderful insights. You actually, in a way, answered a lot of questions which I had, which I was supposed to ask you. But yeah, that was a great masterclass in spirituality and investing and decision making and how to live a successful, happy life. So thanks for sharing that story. You mentioned that you got interested in stocks and investing around the peak of the 99 2000 dot-com bubble, right? And you also mentioned somewhere that your portfolio was wiped off by 2001, right? So tell us about those days and your journey and lessons from seeing your portfolio wiped away, right? So what are the biggest lessons that you learned then? And also tell us that what exactly did you do? What tools and techniques or the resources that you use, or how did you train yourself to develop that mindset of a patient long-term investor at that point of time after seeing your portfolio already almost wiped away completely?
Right. See, when I completed my MBA, the basic knowledge I had was the theoretical knowledge of building the most efficient portfolio. What are the parameters that you look? Basic things like P multiple, PEG ratio. Looking at sort of analyst report, reading through, what they think about the business, and basically relying on, a lot of things which were pushed to you or sold to you. And that is where I think you end up making mistake, because when you start, you think that the more number of analysts who are recommending that stock, the more confidence you get in that company. Whereas it's actually exactly opposite, because the more analysts who are recommending that stock, that means most of investors already bought in. There is no real, buyer left, because whoever wanted to buy probably already bought it by the time the last analyst also becomes positive. And that's where, and then again, relying on just the P multiple or the PEG ratio. I used to look at, okay, if there is an industry, let me figure out which company has the lowest PEG ratio, and then just bet on that and build a portfolio according to that, without really understanding what the business is. And that's where, when the downturn hit, at that time it was all dot-com companies, so like I2 and Siebel and all those which were not really profitable companies, and you fall into that trap of, I mean, they did have some profit, so some P ratio, but the growth was also high, and then PEG ratio sometimes looks decent, but once the growth vanishes, then things completely change, and that's what happened. After that, most of those companies were struggled to survive. And once you start losing money, you try to use your margin money to buy more so that you recover, and that's the trap in which I fell. So that was sort of a rookie kind of mistake, a big mistake. And as I said, for me, that small money that I lost, I mean, that was humongous money back in my village. It would have helped my father, probably repay some of the loan. And then that's where I stopped. I said, until my father, repays off all his loans, and I'm educated enough to investment, I will just stop investing. So first thing I did was enroll myself for the CFA. So at least I learned in depth all the theoretical aspects of investing. I read a lot about businesses, so all like Michael Porter's books uh, and different industries. I tried to apply the investing principles that I learned on things which probably had historical success. Why did those businesses succeed? And it's the same as Shravan and then Manana. Thinking, applying that aspect on various businesses, theoretical obviously, because you're looking at all kinds of businesses which really were multi-baggers, and then you try to reason why did they become multi-baggers, and that forces you to go in depth into the businesses, because you can't just look at, and then again, it's all about relative competence or competitive advantages, that are needed. So when I started focusing on the businesses, the investment uh, practice completely changed. So once I restarted investing around 2003 time period, I only focused on the business, and if I really liked the business, only then I would look at valuation. So that formed, and again, because I had worked with Mahindra and Mahindra, and even my initial job was working with a lot of management corporates. So that also helped me because I'd worked with so many different industries, so many different management. I got an insider perspective of how they think about their businesses, how do they think about their growth, and I was trying to help them in reducing cost. So that gave me a little better sort of edge of looking at businesses, and that really worked for me. So even in 2008, when the whole thing came down, at that time, because of my investing in good quality businesses, I ended up losing much less money than the market and everyone else. And it's all about, you earn a lot of money. Everyone earns a lot of money during a bull phase, but it's how much you protect when the thing falls off. That's what in 2000 I wasn't able to protect anything, zero. Here, at least I was able to protect 70% of the capital that I had when the market fell by 55-60%. So it's all about protecting the money that you make, which is protecting the downside is what you focus on, and that can only happen if you focus on the businesses. You can't focus on just the prices or what others tell you. You have to yourself know those businesses in depth, and there is no alternative to knowing that business knowledge. Nothing else can replace that. So that focus completely changed from just sort of investing instruments to business investing.
You talked about margin of safety. You talked about survival being the most important aspect of investing, right? So I was looking. I was looking through your September 2021 memo that you wrote to clients, right? And I quote a paragraph from there, and you mentioned that stock market cycles typically peak when there are excesses in the market and the economy, and market crashes rarely happen just because valuation multiples are at an extreme. Typically there are excesses at the economy and corporate level too. Given that, I'm sure you also see, like I see a lot of people getting worried about valuations and everything in the current market, and especially like you mentioned, I think in a recent show somewhere else, that this has probably been one of the longest bull runs where we've not had a crash, right, since last March. Almost 18 months of uninterrupted one way chart, right, for the Sensex and the market generally. So where do you see margin of safety as of now in the current market, right, for people who are worried, for people who are looking to invest again for the long term, not for the short term, for the long term, right? uh, which are the areas, or not in terms of sectors, but while looking at a business, while analyzing businesses in India in general, right, where do you find margin of safety, whether or whether does it really exist? Because most people think or generally assume as they look at the price to earning ratio that there's no margin of safety, or there's not enough margin of safety as far as valuations are concerned. But how do you look at the entire picture in that sense?
See, again, as I said, it's all about margin of safety only comes from the businesses. if you had to, if you go wrong, see, obviously, I'm not talking about, paying exorbitant valuations, for any businesses. But even if you go wrong in paying a little higher valuation, it's all about maybe you lose a year's worth of returns. It will go through a time correction. Right? But if you get the business right, you rarely end up losing your capital, because losing a capital, because you can get into at a really low P multiple, and I've seen that, I've done that investment, those kind of investments at the start of my journey. You think that 6 multiple is really cheap, and then 6 becomes 3, and you lose half the money. So my margin of safety mainly comes from businesses. Those businesses have to be, see, I mean, one of the factors that I find different, because Warren Buffett does talk about finding businesses which has moats, right? But I realized that just having moat is not enough. With moat you can protect your territory, you can protect against others attacking, but that doesn't mean that the business will grow. So the only way, moat is just the basic necessity. It's not sufficient for investor returns, because as a promoter you can have a cash cow and you would be happy with that business, that it is a protected business and I'll keep on making that cash throughout my life, and for the promoter it will be a great business. For an investor, unless that earnings or the cash flow keeps on growing, an investor rarely makes any money, however strong those moats are. So you have to look at who are the disruptors, because I have invested in companies where there were a lot of moats, like phenolics cables. When I look at, and then you compare them with, say, Polycab or KEI, the returns are mind-bogglingly different, just because of the non-aggressive nature of sort of the management. Because just having the brand and the strong customer base doesn't mean that you will be able to grow your earnings, and the earnings growth is these bottom line for your investment returns. So having the moat, but in addition to that, you being the disruptor, you have to be the aggressor, is the only way to grow business. You can't sit happy in your existing business. You have to think forward. You have to think what others will do, and you have to be ahead of the game, move along. And that's the only way, as an investor, I can take a call whether there will be growth. Someone who is happy with his own business, it's a dangerous investment. I mean, you may not lose money, but you may not make any money, and the opportunity cost is pretty humongous. So what I feel right now is that the margin of safety today comes from the balance sheet of corporate India, because it's the strongest balance sheet that I have ever seen in India. So balance sheet of corporate India is the strongest. Many of those promoters, probably who used, illegal means, a lot of those are exposed. So the most of the companies today aren't sort of exposed to that fraud kind of thing which could come out. Those are out. The balance sheet of banking system is also pretty strong. And many of the promoters that I meet today, they are sort of the next generation promoters. They are thinking of, how do I disrupt Chinese production? How do I, sort of replicate what the best companies that are doing in the global. They're very knowledgeable. I think that's where that margin of safety comes in from, because Indian companies are becoming the disruptors more and more. Whether it's in the specialty chemical business or it's in the pharma business, in the IT space, they are taking away market share from a lot of companies. So today, P multiple is the sort of the only concern when you look at the conventional method. But when you look at the cash flow ratio, they're okay. They're at an average level. The balance sheet is strong. Banking balance sheet is strong. And whenever you have a strong balance sheet, rarely do you go through a big crash. P&L is something which is unreliable. Balance sheet is something which is real. P&L is very, very volatile. and that gives me a little bit more confidence about the current markets.
I was looking through your investment philosophy. So, a question continuing from what you just mentioned about balance sheets and everything. In your investment philosophy, right? And I found this description of the word sage in SageOne, where S stands for sustainable, A for accountable, G for growth oriented, and E for efficient businesses to invest in. Right. So, take us through your research process about how do you identify each of these four parameters in business, and you can just talk about from a balance sheet and a cash flow point of view, right? How do you and how do you actually quickly look at or reject a business based on these four parameters, or the metrics that you use to really analyze businesses from these four different angles, which are so important for long-term investing?
So you got to figure out what are the things that you can really control. There's nothing you can really control, but at least reasonably, relatively control, right? So if you're investing in a cyclical business, that's not sustainable. The profitability is not sustainable. Neither does the promoter know whether he will be making certain profit 2 years down the line, because his top line is determined by the global commodity prices, which no one has control over. And then the expense structure is something which he has to live with. And then when the top line fluctuates, the margins fluctuates even further. And then if it falls enough, then it goes into sort of loss making. So if there is growth available in sort of cyclical kind of businesses, it's not sustainable. So as what you are looking for in a business, it has to be sustainable growth. It has to be sustainable competitive advantage, which a promoter controls. So something which, so you can be in a steel industry, but where you are just converting. So whether the steel prices go up and down, it doesn't impact. You still make those EBITDA per ton kind of margins. And if you are the most efficient player in that business, typically, and again, you have to study that business well in depth. But if there is, for me, market share gain is just a reflection of the competitive advantage. So I may say that I'm looking for market share gain for growth, because it does add growth over and above the industry growth. But it's a reflection that the competitive advantage are there, and if they have done it for a long period of time, that means they are sustainable. Second thing is the accountability, and what the promoters say and what he has said is what he delivers. Because in India, I think one of the most important difference between how you invest in the US and in India is that execution aspect. Because Warren Buffett may say that he wants to invest in companies where even if it's run by a monkey at certain times, that business shouldn't fall apart. In India, it's not true. I mean, who runs the business is the most important thing. And you have seen examples of Bajaj Finance, and things completely change around. It's all about execution, because India is not an area where you have similar kind of businesses like US. In US, you have so many big brands, you have IP oriented businesses in technology, in pharma. India is more of delivering something at lower cost. It's more trying to replicate what's been done across the world. So it's using that knowledge and executing. That is the most important thing, and that's where accountability comes into play. And then growth. Growth is the bottom line for your complete returns, because without growth, in the long run, you will not really make returns. Because if you are really good at timing sort of the cycles, only then you can bet on some cyclical companies. But sustainable growth is one of the most important aspect that say we look for in a businesses. And then the first two aspects are the ones which sort of delivers the growth. And so these are the factors which over a period of time we realized that you need to look for, and this is very specific to India. These may not be the same factors which say apply globally, and it did not really apply that much in the US market, because the kind of companies which have delivered the most phenomenal returns are very different there than the kind of companies which have delivered in India. A lot of generic companies, commodity oriented companies, which can control and sustain profitability, are the ones which have delivered the most amazing returns. I mean, for me, even finance business is a commoditized business. But you look at Bajaj Finance, you look at DVs, you look at PI Industries, you look at a lot of chemical companies, including Deepak Nitrite, Aarti. From an outside world, these are commodity companies after all, because you are selling, in kgs, and you're not selling products. But still, they are the most profitable companies. And so, if you use global kind of framework to apply that in India, you may not find those kind of companies. But these are the most, efficient and sustainably growing kind of companies. And it only comes through you trying to apply those principles and thinking through what really applies in India, and then designing that strategy which is the most effective and efficient in India.
You've donned the hats of both an individual investor, right? You were an individual investor to start with, right? And you became a money manager. So what differences in your experience have you found in the mindset required for both these roles? Are you more diversified? Are you more conservative as you become a money manager? Or what are the similarities and differences that you really find between these two hats that you wear?
Sure. Sure. I think one of the biggest problem as a fund manager, when you move from an individual investor to fund manager, as an individual investor, you can focus 100% of your time just on investing, and there is no one to really answer to. No one can question you. So, you can have a very concentrated portfolio, and even if you lose money, no one knows about it. Whereas once you become a fund manager, first of all, your performance is out in the open, right? You are answerable to investor, and again, your time gets sucked into non-investment activities, like branding and marketing, building team. Because as a fund manager, you're running a business, and for running a business, getting the right people in sort of incorporating the right culture into the people, how the team works together, it also sucks away a lot of time, right? So the same efficiency that you had as an individual investor doesn't remain. Add to that the complication of liquidity, because once you reach a certain size, I mean, I've seen that if you have to buy 1% in a company, generally the impact cost, if I have to buy quickly in say matter of a couple of days, the impact cost is as much as 15%. And when you exit, and if you don't get the right market to exit, the impact cost can be even higher. So when you put together both sides, 15% and say 15% on that side, 30% of your absolute returns are gone. And say if your holding period is 4 years, the impact cost is almost 7-8% annualized, and so your performance doesn't sustain to the same level, because there are so many other things which occupy your mind, and then add the added stress of investor. So that's where you need to think about these aspects and see how can you remove all these distractions away, so that it doesn't impact your performance how you used to do as an individual investor, right? So you make sure that most of the marketing, operations, all of that is something which someone else takes care of. Because if you try to spend, you are best at investment, you may not be best at operations and marketing. So let someone else, take care of that. Second is about your stress level. How do you manage the stress? It's all about whether you get the right set of investors, because you should be fine letting go of investors as well as saying no to investors. If you keep on taking any and every money that comes to you, you are just building more and more pressure, because many of these investors are not experienced enough to understand the risks in the equities markets. They have never seen those 25-30% of losses. An unfortunate part of the investment industry is that most of the money that you get comes in at the wrong time. because it only comes in when everyone is so bullish, and with the bullishness, that's the only thing which gives most of these inexperienced investors the confidence to come into the market, and it generally ends up coming at the top of the market. So if you are aware of this, if you resist taking that kind of money when the real crash comes in, you end up not managing the investors but managing your investments. And that's what is something that you need to take care as a fund manager, which as an individual investor you don't even have to think about these kind of aspects. And one more thing which I think many probably do not even consider is that, so for example, I, as an individual investor, I bought Bajaj Finance and I have 5 6 other stocks, and I put in say 15% in Bajaj Finance. But if Bajaj Finance does well, sometimes it can become 50 60 70% of my portfolio, and that one company can deliver the greatest returns for my portfolio. But when you are managing outside money, when you are a fund manager, you keep on getting money on a daily basis, right? So just because I bought Bajaj Finance at rupees 100, sometimes it gives me a lot of comfort, because when that 100 becomes say 2000, even if that 2000 becomes 1500, it doesn't really matter to me, because my buying price is 100. I mean, it's an error in the thing. But when you are a fund manager, you will have investors who buy in at 2000, and that 2000 becoming 1500 is a 25% loss for that investor. So I can't have the same portfolio replicating, which as an individual investor, I would have developed. I would always have Bajaj Finance as say 10% of my portfolio. So it does impact, because when you bring in the risk management aspect, you cannot deliver the same returns, because even in there, once you become a say 50, once one stock becomes 50% of your portfolio, it can go either ways, right? I mean, if it does phenomenally well, if it continues to do phenomenally well, your portfolio will deliver great returns. But if something goes wrong, it will also have the negative impact, which as an individual investor, since my buying price was so low, I could take it. But when I'm doing it for public money, so there are a lot of drags. As a fund manager, you're almost tied with so many of these difficulties, and it's underappreciated that as an individual investors, you can easily deliver 15-20% in incremental CAGR, because you can go get into small, minor, micro kind of stocks. Whereas in here, because of liquidity concerns, especially when you hit that crash, you want to be able to get out. You let go of so many opportunities, which probably as an individual investor, you could just pull the trigger. But as a fund manager, you just can't. So accordingly, you need to build your strategy, which really works as a fund manager. And it's an adjustment, but it's an adjustment which has to be made. Otherwise, the results will be borne by the investors.
So given all the stresses of being in the money management industry, right, and the regulatory aspects, right, all the risks that you talked about, right, what really keeps you being a money manager? Or are we expecting Samit to hang up his boots someday, maybe not now, maybe 5-10 years down the line, go back to the village, be a farmer, something like that?
No, I mean, it's a really, really good question, which, I keep on thinking. But it is something that I have started enjoying. Initially it's an adjustment, but if you adjust your business, if strategy aligning with, these restrictions, then, and especially if you get the right set of investors, the advantages of a fund manager, it keeps you very disciplined, because as an individual investor, you don't have to think on a perpetual basis. You can get comfort in something because you got that stock at a really good entry point. Whereas as a fund manager, for me, every day is a decision making day. If I'm getting a new investor, at a certain point, if I feel that this stock maybe it's too overpriced for adding to a new investor, then I need to question myself Does it even need to be in my existing investors? Because if I am not feeling comfortable, then why should I have it in my old investor? Because after all, I can't just look back. What happened in the past is gone. I only can look forward, and my portfolio today has to be positioned so that it gives me the optimal returns, for an investor from today and going forward. And that can't be much different for an existing investor versus a new investor. So it does keep me disciplined. And when you are answerable to investors, you think from a very, very multidimensional perspective. Your mind is much more active, and I think that's something which is a requirement for an investor. So keeping yourself on the toes. And main thing is the stress, which if you take care of that aspect, which again there is no alternative but to look at the practical aspect of spirituality, which we spoke about, where you give your best. What happens in terms of returns, what happens in terms of how much AUM get, should not be a concern. What you need to be satisfied that you have done the best to the extent of your abilities, and then the stress doesn't. Because if you keep on expecting that I need to be the top fund manager, I need to deliver more than this percentage of returns, which absolutely is not in your hand. There are so many things which are just pure part of luck. Just being in right place at right time helps a lot. For example, I had, say, a couple of bad years in 2018 and 19. If I had started my business in 2018, I probably would not even have survived as a fund manager. But because I started in 2012 and I had 3-4 years which were really favorable, it does help. So for someone, say, who was just investing in high quality large cap businesses, and he started in 2017 or end of 2017 and 18, and that strategy outperformed the broader market, you have a great start, and that just builds momentum and it keeps on building that business. So right time, right place, luck plays a lot of big role in how you succeed. So you can't take everything so seriously. Life has to be just unfold in front of you, and you accept whatever happens. It's your role is to just do to the best of your ability, with compassion. You need to feel for the investors too, because there are so many investors who are coming to you for their retirement and saving. You got to feel for the investors, and from your heart, if you really want to deliver, most often it does work out. You may go through a bad patch, but if you have the right efforts and right heart in place, generally it works out. And I find that journey with discipline, where I'm answerable to investor, it sort of fits me, my temperament. I'm okay with the stress that comes along. I do not really take that much of stress, because I don't really have certain benchmarks that I need to meet. I'm okay whatever comes along.
Those are great insights, Samit. Talking about investment mistakes, right? When you look back, I'm sure you must have your bag full of mistakes as well. If you look back, right, in hindsight, were there any common elements or themes in your mistakes, or specifically, just like to make it more simpler? Is there a specific mistake that you have made again and again, or probably more frequently than others, right? And which, if you want to talk about, which has been your most memorable mistake? The reason I'm calling it memorable is that may have led you to the biggest lesson, that, or one of the biggest lessons that have helped you later in life as an investor.
So, see, I think the most common mistake which has happened, because after all, you need to, when you are looking for 25% kind of growth, because I would look at businesses which will double their earnings in next 3 years or 4 years. So these are aggressive targets. I'm not looking for 12-15% kind of a growth. But because then you would be okay investing in HDFC Bank, Asian Paints, and a lot of those really good high quality companies which deliver that kind of growth. But as soon as my expectations double, it does returns don't always come in with the same kind of risk. You have to increase your risk, and you have to invest in businesses which are high growth businesses, which sometimes are at the start of their journey. I mean, though we don't invest in sort of startups or really new businesses, but they do have history of 5-10 years, but they don't have history of 20-30-40 years sometimes, right? So the biggest challenge comes in when you bet on a business where you think the profitability is sustainable, but in reality it turns out to be a very cyclical and commoditized business. So I've done mistakes. I had bought a textile company, and it looked like a structural story because it was exporting to the brands in the US like Target and Bed Bath and Beyond. And then as soon as the competition came in from Amazon, their profitability wasn't sustainable. I mean, the biggest problem is with the cyclicality in the profit margin. One more company, Sterlite Technology, which I was really positive about, but then there was oversupply at a certain point in time, and then the Chinese just dumped across the world, and then the prices collapsed. So what you thought was a structural story which is building up turns out to be a commodity kind of business. So as I said, as a fund manager, my initial buying was at 100 rupees. It went to as high as 400 rupees. But since you are thinking that it's a sustainable long-term business, you end up buying for NIM investor even at 400. So even if that 400 drops to 200, it's a huge loss for those investors, and that hurts. And even though today they say the price is at 300, from bottom to 300 is 3x the money, but there could be some investors who are still in loss. So as I said, for me, this discipline of evaluating that business at every point in time, at every price point, is very important. And that's where my mistakes have happened. And I'm more and more careful when I invest in a business. One distinction has to be made. Is this something, are the margins in the control of the promoter, or are they completely driven by the market? And the more you lean towards the market, I mean, of course, you will not find entirely the margins are in control of the promoter. There is uncertainty. Even in the best quality businesses, you will find, but the volatility in the margin has to be very low. As soon as that volatility in the margin increases, that's where the risk comes in. Because if you end up at the higher end of the margin and the lower end of the margin, there is a double whammy. One is your profits drop as well as your P multiple drops. So, you can end up losing 50-60% of your value in a matter of, just a quarter or two. So those are the mistakes, which tend to happen. And see, many a times exit decision is very tricky, because one of the biggest mistakes that an investor who is doing investment for the long run is that exiting too early. So when there is a hiccup in a business, which even Bajaj Finance went through multiple hiccups, during this 150x kind of returns over the last 10 years. But when you evaluate that hiccup, that's where you need to figure out whether this is a short-term transition phase or this is something which structurally has changed in the business. At that point, if you dig deeper enough, then you realize that those businesses like, whether it's the textile business or fiber optics business, you realize that it is a cyclical in nature kind of a business. So there at a price point, you need a lot of margin of safety. You can't afford to buy such businesses at high multiples. Whereas if it's a structural story, there is much more freedom you have of going up the price range. So Bajaj Finance, whether you bought it at one time price to book or whether you bought it at 4-time price to book, it made sense at that point in time. So you do get margin of safety. Whereas if you end up doing that error of classifying a cyclical business as a sustainable business, and you end up paying high price, that ends up becoming a big mistake. And those are the mistakes that I have done. And you, with every mistake, you try to learn, even though you cannot avoid 100% of the mistakes, because when you are holding for a long term, you will face. I mean, fortunately for us, if you look at last 10 years, uh, we have invested probably in 80 businesses, and out of those 80 businesses, 40 businesses have delivered more than 25% CAGR, which is sort of our benchmark. And roughly about 12 businesses have delivered losses, and that is part of the investment journey. You cannot have 100% of business which will deliver. You just have to learn from those 12 businesses you lost money in, and incorporate that in your next pick.
How do you view this idea of something like a coffee can investing, right? Being in the market, like we have been in the market for like almost 2 decades, 15 years, 20 years, right? We may be able to do a lot of research, identify companies, meet managements, and all those kind of stuff. Understand what really separates a good business from a bad business. But for a lay investor, maybe for a retail investor who wants to go ahead and still identify stocks, right? Apart from doing mutual funds and all those kind of stuff. Uh, Probably not having enough money to invest in a PMS, but still wants to pick up stocks. Is a coffee can kind of investing or a derivative there where you buy high quality businesses? You do some basic analysis. Okay, that's the reason you understand that these are good quality businesses. You do
Right.
some like quick metric, quick analysis kind of stuff. Do you think that's a sensible way of investing? Like buying it, not forgetting it, buying it, shut it, like closing it in the coffee can
Yeah.
and forgetting it for the next 20 years. You still review every year after year after year,
Sure.
but you don't touch your portfolio just for the sake of making any changes. You keep it very simple, right? Do you advise certain that kind of a thing, or should a investor who is new to the markets or who wants to pick stocks, you would advise and probably go through a mutual fund route or through an index fund route or those kind of stuff?
No, I think, see, my belief is that your returns will be determined by the earnings growth of the company in the long run, right? So, when you're doing coffee can kind of an investments, and especially if you don't have enough time to spend, on your investments, because if you are doing a parallel career, you will not have enough time to spend, and accordingly your return expectations have to go down. From my experience, I think these really high quality businesses, which have 10 years kind of historical parameters to meet the criteria that you're looking for, in their growth rate tends to be in that low teens, anywhere from 11 to 14-15%. And if that's your return expectation in the long run, it's a less stressful journey of delivering those kind of returns, because these kind of companies will fall much less whenever there is a crash, because they tend to be more defensive in nature, they are large cap in nature, and they are less volatile in nature. So less volatility uh, in that mid teens, low teens kind of return, if that is what you're looking for. And sometimes at the start of the journey, that is what you look for until you really increase your knowledge base, and you're willing to take a little higher sort of risk. But again, for me, if I'm doing this as a profession, I am not happy with those kind of returns, because I think if you are taking risk coming into the equities market, especially markets like India, you got to generate 7, 8, 10% kind of an alpha. So if your Nifty delivers you 15% in the long run, I need to deliver that 20 to 25% kind of returns. That's where it's worth, spending your 24/7 kind of time on these. So if you're doing it a full-time job, maybe coffee can is not the right kind of investment. But if you do not have the time to spend, I think it's really less stress and smoother journey to those returns. But one has to also think through, what really makes coffee can work. You can't just go with the recency bias, because if you look at last 10 years, the returns from a lot of these high quality consumer oriented companies have been close to 20% annualized in the last, compared to probably low teens for the Nifty. So significant alpha that these companies have delivered. But if you break that up into returns because of earnings growth versus returns because of valuation re-rating, 11 to 12% is because of the earnings growth, and remaining 8% is because of the valuation re-rating. Whereas the valuation re-rating is something which can't just keep on replicating over the next 10 years, because they're already, the valuation has tripled during these last 10 years, and that has delivered that 8% return over the last 10 years. And so you have to accordingly adjust your expectation from this kind of investment, and I feel it will be more towards the low teens than the 20s, which is delivered in the last 10 years. But that itself is a pretty good return, when you compare the FD rates today, which is at 5 to 6%.
I think the problem happens when someone wants to be a part-time investor, right? But still want to generate that 8 to 10% alpha. I think that is where most people get into problems in investing.
Exactly.
From an advice to investors, right? What would be your advice to someone who's looking to start managing other people's money, even if in a very modest way, right? What are the best things he or she can do and the worst things he or she must avoid doing while starting out as a money manager?
I would say in a to-do list, you have to figure out what exactly is the investment strategy that works for you, which is replicable to the investor. So it can be done at a scale, because sometimes some strategies work at a really small scale, and once you scale up, those become very difficult. So you need to think through your investment style, because something the one of the most important thing that is required when you do it as a business is that explaining exactly what you're bringing to the table, exactly what is your product. So you need to be crystal clear what you will do as an investor, because investors put in the money, exactly understanding what the product is. But as you go along, as you build scale, if you end up tweaking that strategy because it's no longer works at that scale, that's mis-selling. And investors are okay if they understand what the risks are, and even if the portfolio goes down, if they understand why the portfolio has gone down, because it's just part of that investment style. But if you keep on sort of switching, so there has to be full clarity about what is it that you are selling to the investors, and not it shouldn't end up mis-selling. So that is the must to do, and you should try it on your own. You should have at least tried it for 5, 7, 10 years, whether that strategy really works on your own. Don't do it with just a couple of years of experience and then try to manage clients' money. You need to go through at least one cycle, if not two cycle of downturn, and see how that strategy really works. Or you can even do some back testing of having a certain strategy, because coffee can also is that kind of a strategy where and you can back test how that specific strategy works in especially stressed situation. And you need to develop a strategy which really works well in stressed situation, and because that is where there is the highest probability that the investors will question you and want to redeem from you. At that time they need to be comfortable, because you can develop a great business in a bull run, but that business can be destroyed when you hit the first bear phase. And thinking through and developing that strategy is very important. What not to do, I would say, when you go for a business, don't go in there for money. Don't come in thinking that as a fund manager I will make this kind of fees, and it has to be your passion. It is something that you enjoy, because as I said, moving from an individual investor to a fund manager is extremely stressful. Are you ready for that? Are you compromising on a lot of freedom that you had before you became a fund manager. And that has to, one more thing I would say, that do not manage your own portfolio differently than the clients, because it's unfair to the clients. If I have completely different set of stocks in my portfolio too, I will have so much of my mind share focusing on my own stocks. Because as a fund manager, you probably will be ending up investing in larger and larger companies because of the liquidity issues. Whereas you know that I can make the most money in these micro cap and the small caps. So don't put your interest in front of the clients. Keep it aligned, because your time is the most important for your returns, and that has to be the focus.
In your role as a money manager and also as an investor, we're all surrounded by a lot of noise, a lot of information that we want to see soak in, right? Because we think that the more the information, the more we're going to get wiser as far as our investing or picking stocks is concerned. But what I've come to believe is, I think, given so much noise and information around, and also especially the idea of being able to think independently, right? Uh, how does actually one do that? One way is to say no to noise. That's the simplest way. No newspapers, for example, no much of WhatsApps and all this kind of stuff. What have you done, especially in your role as money manager? There's so much noise which you must be bombarded with day in and day out, to keep your mind independent of what the world is talking about, to live with something what Buffett called an inner scorecard. So, how have you been able to do that in your role as an investor and money manager?
I think that's the biggest problem with the social media, is that you get bombarded with so much information, and especially as a fund manager, you are tied up with 10 brokers. So those 10 different brokerage houses will keep on sending you different strategy reports, different analyst reports. There is unlimited amount of data that you need to go through. I think most important is, over a period of time, you need to realize out of that 90-95% is something which is not going to be useful to you. So, what is that 5 to 10% I need to focus on? Because after all, you do not have unlimited resources, unlimited time to go through. So, what you reject, what you say no to, is very, very important. So, what I have done is that, okay, I used to be part of a lot of WhatsApp groups, especially on the investment side, but now just one or two close groups is where I am in. I have got out of all the other WhatsApp group, because you do get information. You go in because you might get one idea, but that's not how you really get ideas. You will have to build your own conviction. So it's important that you figure out what is important as knowledge, which adds to your understanding of the business. Because a lot of the data that you get is more to do with market timing, where things are, what's happening in the globe, interest rates and commodity prices, which, as my investment style, it doesn't really make much of a difference. Because if it is making difference to your portfolio companies, then you are doing some mistake in choosing that portfolio companies. Because if you are relying on day-to-day data and price movements, there is inherent weakness in that business. So if your style is to bet on sustainable structural, long-term structural growth stories, lot of those become complete noise, and you just avoid those. Because after all, what you spend time on has to add to your understanding of those businesses. And once you stay away from, because I think lot of reading that you do is also sometimes market related, macro, all of that, which I have questioned myself, does it really add much to the understanding of my business? Those are good to know, because that same time you can spend on understanding industries, understanding companies much better, understanding competition much better, understanding the new trends which are coming through. So you identify what is really important to you and keep on rejecting. It may not happen right at the start, but over a period of time you will realize what to just dump it into the trash can, and what just to focus on that 5 to 10%.
My next question is about your role as an entrepreneur, right? So, apart from an investor, money manager, you're also an entrepreneur who started a business almost 10 years back, more than that. and you built a team. You've seen through cycles as far as your business is also concerned. So, what are your most important pieces of advice for a young entrepreneur who's looking to start out? He may be starting out in any, or he or she may be doing that in any industry, right? But what are the most critical elements that that person needs to focus on when starting out his or her business at this point of time?
Yes, I think the most important thing is obviously, you need to be really passionate about that business. You need to really feel from your heart that this is something that I want to do. And you need to think from a client's perspective. That has to come first. Then comes in sort of how do you structure your business, where, as I said, for me to add the most value, I need to delegate work, whether it's the marketing work, operations work, even research work, I need to delegate, because as you build scale, you need to rely more and more on your team. So you need to focus on bringing in the best talent, but more importantly, I think it's how the team works together, because there should not be friction within the team. So as an entrepreneur, you need to make sure that you give them the freedom. You cannot be a micromanager, because team doesn't come to you just because of the money that you offer, but also the freedom that they get. That is extremely important. They need to get that freedom. They need to enjoy working together. You cannot have targets on their head. You cannot just question them on what did you deliver in the last 1 month, because that you need to do while choosing that person. Is that person someone who will independently work without you sort of spying on him? So that freedom is extremely important for any entrepreneur. I think hiring the right people, giving them that freedom, delegating work, and developing the right incentive structure for them, becomes that becomes more of a sustainable business without you having to sort of micromanage. Because micromanagement, I think, has been one of the biggest problem in Indian promoters, where it's difficult to let go of responsibilities, and that we do observe in the investee companies that we look for. Wherever, if you visit that company and where you feel that everyone around them is so fearful of the promoter, where they are just doing the job because of someone tracking them, and that's not how the culture has to be built. We generally try to stay away from such companies, because those businesses are more promoter driven, and they will be restricted by the promoter's ability to scale. You have to delegate, you have to rely on people, trust people, incentivize them, and you need to work really well together, enjoy the working together. You need to feel, going to office and interacting with those people. I think that has to be the goal. Again, bottom line has to be happiness. It cannot be just money at the cost of adding stress. And business is a stressful journey.
To bring in Warren Buffett, right? He's talked about that we are all creatures of habits, right? And good habits are what makes us over a period of time, and that the best investment, as he's mentioned, that is the investment that we make in ourselves. So, two questions here for you. What habit would you say most positively impacts your life? And number two, what new things are you learning outside investing and money these days?
For me, I mean, the spiritual journey, I think, just I used to question about why am I here? What is the purpose of life? Because I used to try to find that purpose. Slowly, as I met more and more friends who were way ahead of that spiritual path, I realized that why does there need to be a purpose? It's why don't we treat it as an experience? It's unfolding in front of you. Experience it, enjoy it. Like you do a movie. And just live that life to the full extent. I think with that, and it doesn't come naturally. Obviously, you need to put a lot of efforts. In meditation, you need to spend some time, and meditation has to become part of your life. It shouldn't be that half an hour or 60 minutes of exercise. So that habit has helped, because in addition to moving ahead in really knowing yourself, because the end goal of this is to know who am I, right? As Ramana Maharshi says, that is the core question: who am I? And that meditation is the only way. Focusing inside, will you slowly know who you really are? You are not the body, you are not the mind. You are more than Brahman, who is more of an observer or experiencer. So that journey continues, but the side benefit of that is that it increases your focus. Because the more meditation you do, it definitely reduces your stress, and with less stress you are much more efficient. You enjoy your life much more. You don't try to live life for others. What will make others think that you are successful. And those are the habits that I try to sustain. And again, reading is important, but more than reading, it's the thinking part on the reading, where you try to find the applications of that reading in what you do. So you need to be clear on what the readings are. One is the reading for my entertainment, where it could be just a casual reading. That is fine, you can read. But if you are reading for your profession, then you need to make sure that whatever I read, I put much more time in applying that in what I do. And then once I'm convinced that okay, this is something which adds value, it becomes part of that my entire strategy. So it's that Shravana, Manana, and Nididhyasana, which is important in that.
You mentioned about you meeting Swami Sarvapriyananda in New York a few years back, and you asked him some questions. Do you remember any one specific question that you asked him, and what was his response to that?
So see, I went there where I was in New York, and the Vedanta Society is right next to the Central Park, very close. So I walked there. I just took a chance, because I used to hear his YouTube for years, and I was really stressed at that point in time. 2018 was a time period when the Nifty kept on going up, and the small mid caps, struggled. Though we did way better than the indices, but still, I mean, when you lose money for the investor, it gives you a lot of stress. And that was in my last 10-year journey, that was the first big real hit in the portfolio. I mean, this portfolio does go down by 10-15%, but that, just part of the game. But this time it was down like 20%, 25%. So with that stress, I was thinking, I mean, is this something that I really want to continue? Is this stress worth it to take? And then how do I reduce the stress? And that was sort of initial period of my journey into Advaita Vedanta and that Vedantic thought process. And I had a lot of questions. I had a lot of questions about my purpose of life, and why am I here? Is this worth it? So those were the kind of questions I asked him, that I'm going through this stress. First of all, how do I reduce that stress? Because it's really painful. Right? And so, I mean, his answer was the same thing that I'm talking about. It's all about don't judge the situation as it is now. There is a long journey ahead of you. Just do best that you can at this point in time. Just focus on that, and something which may seem really stressful, bad, could be the biggest gift that you have. And actually, once you change that thought process, so that change at point in time is that I stop judging every occurrence with that bad and good, and it reduces the stress. Why do you need to judge? Because you do not know what are the repercussions of that event. Something which seems great. You can have a sort of teenager crush, and you think that if I get that girl, my life is all set. I will live in heaven forever. But it never really happens. Something which you seem like the best thing that happened ever to you can turn out to be, the worst thing that happened to you 10 years down the line. And it happens in life. So, yeah, I mean, that is something which that meeting really helped.
About books, which are your favorite investing and non-investing books that you highly advise people to read?
Yes. So for investing books, as I said, my focus completely changed on the businesses. So understanding Michael Porter is one of the books, and his own book, the different strategies. That's definitely extremely useful, because at least it provides some framework of looking at businesses. And depending on your own, whether it's in India, that framework has to be adjusted, because he would write books based on maybe his experiences, mostly in US, and a lot of those experiences do not apply in India. So that is definitely useful. In the recent times, I think investing the last liberal arts, that the liberal art, that also, I enjoyed that reading, because especially during COVID times, you try to reason and put logic to everything, and there is so much uncertainty in the world. You can't look at investment as mathematics and physics. It is much more liberal, because investor thinks way ahead of time, and so prices move based on what is the expectation in the market. You can't link it to specific formula, and that's what I think that book is brilliant. Even Neeraj suggested me that book, and he's a great reader. So, and outside of investment, I do hear a lot from Rupert Spira. He's a really good. He puts Vedantic concept in a very scientific point of view, and then a couple of other speakers, Donald Hoffman and David Chalmers, they talk about consciousness, more scientific, neuroscience point of view, but it is amazingly close to what Vedanta says. And I really believe that we have such a treasure of knowledge, which the Indian population is underutilizing, and it is the most scientific way. It's just that we are really bad at marketing, and we get influenced by the Western marketing, and try to focus on like secret and the power of positive thinking, which I feel this is much more superior for your sustainable long-term happiness.
We all receive a lot of advices in our life, some good, some bad, right? So for you, if you remember, what has been the single best piece of advice you ever got, and what has been the single worst piece of advice that you ever got?
So I think sometimes something seems to be the best piece of advice at that point in time, which maybe 10, 15 years down the line, you realize that it wasn't that great. So as a kid in a village, a lot of, my uncles used to tell me that, just go to the city, earn so much money that people will, start respecting you, because money is core to everything, and so I feel now, I mean, it is one of the worst advices, that because money doesn't mean you are happy. Happiness is independent of how much money you have. And, the logic that is given to money making is that it gives you a lot of freedom in terms of what you want to do, when you want to do, whenever you want to do. That works perfectly well. But then what you realize, that as you make more money, it brings in a lot of responsibilities. With that, a lot of stress. So you are still tied to a few things. You always keep on, if I, achieve certain target, if I achieve this. So your happiness still is tied to certain achievement. That means you really don't have the freedom. So if you really want real freedom, it only comes through, certain spiritual path which fits you. I'm not encouraging anyone to just look at one path. There are multiple paths. It has to align with your own thought process. It has to resonate with what how you think. But that is the only way of gaining real happiness. And the advice that say Swami Sarvapriyananda gave and we spoke about, that really is the only way to have that lasting sort of blissful happiness, not just short term happiness that you get after, because human mind is so that you can achieve the best thing in the world, but it adjusts, your benchmark just goes up, and you don't get happiness by sustaining that achievement at that point in time. It only, you'll get higher happiness, because that happiness will die off in matter of maybe few days or few weeks, and then you got to achieve much more than that to gain more happiness. There is no end to it. So running behind money will just go behind what you really enjoy, what gives you happiness, and change the perspective of your success. I think that advice definitely turned out, or right now I'm thinking is the best advice. I don't know what happens 15 years down the line. That's the
No, I
truth
think that's
right now.
I think that's a value. I think one of the most valuable advices for people who are on that hedonic treadmill of running after money, success, fame, all those kind of designations, right? All those kind of things. So great. And here's my closing question to you. So, if you could have dinner with, or lunch or dinner with any one person, dead or alive, who would it be and why?
For me, Swami Vivekananda, because he was the one who was instrumental in explaining this Vedantic thought process, and he actually went through the entire Shravana, Manana, and Nididhyasana. So a lot of today's monks probably are at that Manana stage, but he went through that Nididhyasana phase where internally, at least, he had much better knowledge of who we really are, who he really is. And for me, even getting half an hour of discussion will clarify a lot of thoughts, because this journey is all about answering questions. It's questioning your beliefs, and there are very few people who can clarify those doubts, because you don't find those level of people around you. So just having that few minutes, half an hour, I mean, it would be a dream for me.
Sure. Let me ask you one more question. So let this be the final question now. So outside
Sure.
money, investing, managing money, other people's money, right? Spirituality that we've all talked about. What are the things that you do? What keeps you occupied and brings you the most joy in your life?
Yeah, I mean, see, I really love sports, so I play a lot of sports. I try to, because you don't get enough people to play. Like, I really play. I used to play cricket throughout my childhood. I mean, the any time that I got was just playing cricket, and it we didn't even have the proper equipments. We would just get some the coconut leaf end to play cricket, and so if I don't get to play cricket, I watch cricket or watch other sports. I love all kinds of sports. When I was in the US, I used to watch American football. I used to watch ice hockey, basketball, baseball. I even tried playing baseball, because that was the closest to which I knew. So here I try to encourage my kids also to come to play badminton. Sometimes they do, sometimes they get bored. But sport is, if I probably wasn't an investor, I would have had the most fun just playing different kinds of sports.
So with this, thank you so much, Samit, for spending like your precious 2 hours with me on this show. A lot of insights for me, especially the one where you talked about not focusing on what is happening now, not really probably trying to connect the dots, like Steve Jobs also said that we all connect the dots in the past, not in the present, right? So not really being judgmental about what is happening with you or what is happening around you today, and looking, and probably like we do in investing, like giving a long view, a long shot, a long view kind of stuff on things that are happening around you, and not being bothered with these kind of things which are happening around you. So thank you so much for spending all your time with us. Great insights for me. Thank you so much.
It's an absolute pleasure. I mean, the kind of questions you ask brought hopefully something which will add value to the listeners. And really thank you for doing this.
No, lot of value, I'm sure, a lot of value. Thank you so much, Samit.